Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for February 15th, 2021. Please see our disclaimer for important information. In our commentary this week, we'll cover the equity markets, a little bit on the fixed income side, and kind of talk for a few minutes about the inflation picture as it's kind of shaping up. And then there's some other things kind of that I found kind of looking through the Wall Street Journal a little bit this weekend that I thought were of interest, maybe a little bit of Barron's as well. But as we get started, so last week the Dow was up 1%, the S&P 500 was up 1.2, NASDAQ was up 1.7, and the Russell 2000 was up 2.5%. And markets continue to be fueled by, vaccine optimism, and optimism over the passage of fiscal stimulus. It looks more and more likely that we're going to get a bill born out of budget reconciliation than true bipartisanship. And what that means is that budget reconciliation is a way that you can pass revenue legislation on a purely simple majority basis as opposed to the 60 votes required otherwise. So there's increasing optimism over that, and because of reconciliation, it appears that the net stimulus is going to be probably a little bit larger than I think we would have guessed perhaps a couple months ago, maybe a little bit closer to the 1.9 trillion than perhaps the lower end of the figure that was being bandied about earlier. And then beyond that, there's an infrastructure bill that's being discussed, and perhaps even green energy type stimulus legislation, which would throw a lot more money into the economy. But notwithstanding, those are optimisms that are fueling the market right now. But we've got a lot of outperformance from the S&P, from the Russell 2000 over the S&P, which is so far up over the S&P 500 by 11% in the year to date. But we have a lot of things going on that I think are worth paying attention to. I mean, volatility in the equity markets has actually been above 20 for almost 250 consecutive sessions, and that's the second longest streak in more than 30 years. So we've had, even though it hasn't seemed like we've had a lot of volatility, and we haven't had a lot of big volatility, but we've had enough that's kind of been above average for a while. The 10-year average is actually about 17.6. And then the last trading day of the week, Friday, was actually down just slightly below 20. So it's interesting that volatility remains elevated at a pace which I think we should certainly pay attention to. I mean, this is a period where we're seeing certainly cyclical stocks do better than defensives. We've got a chart of the week on that. We've had some kind of rotation in the market. So originally we had a lot of the stay-at-home beneficiaries perform well last year, and then the areas that were hurt, like banks, department stores, so on and so forth, caught a bid a little bit later last year, and then small caps have really done pretty well. And but since we've had some mitigating data insofar as the high frequency numbers are concerned, and we still have some measured and percentage lockdowns in some areas. So it's a little bit of a mixed bag, and so some of those areas aren't just that either rotated in and become more in favor. They're not necessarily performing as well right now. But needless to say, the percentage of companies that are beating estimates on both earnings and revenue are at a record, and it's and I guess it begs the question, as we exited the fourth quarter. And we've gotten most of those earnings now for the S&P 500 for fourth quarter activity only. And 6 months ago, the conventional wisdom was that earnings were going to be down meaningfully year over year. And as it turns out, earnings are actually going to be up year over year, even amidst the pandemic, which is actually phenomenal when you think about it. But it makes you wonder if companies are better at being able to manage their expectations down, so they can have a bigger beat. And we've got a chart of the week in our package this week where it shows earnings estimates for 2021 are just amazingly high, like well over 25%. And I mean, at first blush, it would seem to reason that you'd want to go into it with a little bit tempered expectations. But the way that companies are conditioning people now is that, oh well, we know that they're going to beat those numbers anyway because they're managing them down. So it's almost kind of reinforcing this psychology in the market that earnings estimates out there are being managed conservatively. The other thing, which I think is a wild card, and we talk about it a little bit in the charts of the week, is that earnings estimates in general, earnings guidance by companies, is much lower than it has been pre-pandemic. Really, literally half of the companies that were giving guidance are now giving guidance now. So your body of feedback that you're getting from companies is not nearly as great. So it just kind of maybe calls into question a little bit the viability of the earnings estimates that are out there. But so and a lot of people are actually drawing conclusions based on the robustness and the move in the market to 1999. The feeling that this looks a lot like that. In many respects, it does in terms of activity, but the 50 largest stocks in March 2000 had a median price to earnings ratio of 31. And right now that's about 23, 24. So we're not quite where we were, although I will say that within that 50 largest stocks in 2000, we had some really, really high flyers, and high flyers that were frankly didn't have a lot of revenue. So on that metric, maybe not so much. And if you look back at 1999, the 10-year Treasury was around 6%. We're about 1.2% now. And we've got a steepening yield curve now, whereas back then we had a flat curve, and usually a flat curve is kind of a precursor to a downturn. So, the fact that we're having steepening in our yield curve, meaning that longer term rates are rising faster than short term rates are, is a bit of a bullish sign. Good for financials, good for savers. Not so good for the real estate, residential real estate, and mortgage industries, but what it could, portend, especially the government running huge budget deficits in now versus back then in 1999. I guess one of the implications is you've got the Fed is out there buying a lot of bonds. And putting in more liquidity in the market, which we've talked about for quite a while now, that that should empirically lead to inflation, and we've got some other inflation producing activities going on in the market right now. But so equities, basically, long story short, is that we have high percentage of beats. There's a lot of optimism in the equity markets, and you still have low interest rates, which are that and earnings growth is really the mother's milk of having a strong equity market. But on the fixed income side, interestingly, we've hit 2% in the 30-year Treasury for the first time in a year, and ironically, that happens to dovetail pretty nicely with the Fed's inflation target. But what's interesting in that is inflation expectations are going up. We had a chart of the week of that. And break-even inflation on a 10-year basis is about 2.2%. So the expectations are clearly for an increase in inflation. That's being built into the Treasury markets, and you've seen even 1.2% on the on the 10-year yield, and and that's up significantly. That's basically double where we were in just in a matter of, call it 6 to 7 months. But there are concerns over inflation. We've talked about this in charts of the week. There's some slides. Producer prices are going up. We know manufacturing's been strong, but input costs have gone up, and we feel like those are eventually going to be pushed out to the end buyer. We've got some labor constriction issues that are causing unit labor costs to go up. So we want to monitor that. So input costs are helping to drive that. Inflation expectations are going up. And, the other interesting dynamic that we've got going on, with regard to fixed income versus equities is that we have, this is in Barron's, but 70% of the S&P 500 companies actually have a yield that is higher than the 10-year note right now. And, if we have a continued rise, and I honestly think that, we're probably more than likely to have a 10-year Treasury yield of somewhere close to 1.5%, that if we had that rise, maybe a little bit more than that, that we'd have, only 40% of the S&P 500 companies that would have a higher yield than our 10-year Treasury. And, the S&P yield right now is 1.5%. So obviously, the more the market goes up, the smaller that yield is, and that's just it's an interesting conundrum. And then that, coupled with the fact that we've got junk bonds that are doing extremely well. In fact, the average year in Bloomberg, the average yield on junk bonds is below 4% for the first time ever. This is reported by Sandy Leeds in his weekly comments. And the triple C bonds, these are bonds that have a very high likelihood of default, are actually down to a record low of 6.2%, which is absolutely phenomenal. So, I mean, we've talked about how credit spreads have really narrowed considerably here in the last 6 months, and they continue to be really, really tight. People are struggling to find yield. And they're certainly migrating into some of these high risk areas. So, the market on balance continues to have a really risk on bias right now. So, and equities are also being helped, of course, by the fact that, we've got more inflation built into real yields, and short-term real yields are really negative right now, and that's helping equities. Not so much gold, but definitely equities. But so, just kind of looking at some other points in the market, inflation. Yeah, let's talk about that. So, core consumer price inflation was up about 1.4%, maybe a little bit less than expected, but still a long way from the 2% that the Fed is looking for. And the Fed is going to keep its foot on the throat of short-term rates, so they're going to remain, very accommodative for a long period of time, and then we're going to get more fiscal stimulus. So, and then that's just going to continue to drive liquidity in the market. That, again, under the theory of TINA, there is no alternative. That equities are still going to be able to catch a bid more than likely, and even though Treasury yields are moving higher. There's still room for short-term bonds or bonds of limited duration to do okay, especially as their yield goes higher. But inflation is going to naturally have an adverse impact on equities over the longer haul as some of the inflation gets materialized. It puts a lid on how fast the market can grow. We have some choke points in production that we know, and we know we're getting more liquidity. So what we have is kind of more money chasing fewer goods, which is really the textbook definition for inflation. We know the Fed's not going to raise rates for a long time. We've got a lot of stimulus coming. And the other thing that we know, and also we've got some charts and charts of the week for this, households have a lot of dry powder. There's an awful lot of savings. We basically had, well, consumers have about 1.6 trillion of standby liquidity. We know businesses have raised a lot of capital. We know there's a lot of pent-up liquidity that could be deployed with increased confidence in 2021, which, if the consumer is going to take that liquidity and put it to work, take those savings and consume with those savings, that could also have an upward bias for inflation as well. So let's see. In inflation, I see people, talk about in some of the readings that, we've got more technology, we've got, more productivity. We have this digital economy that is taking cost out of the equation, that we're going to, maybe have lower overall inflation. But we've seen this before, and I think what it could be doing, and we got to watch out for this, is kind of lay the feedstock for unexpected increases in inflation, because that's what we don't want. As long as the inflation we see is what we expect, and it's at a measured pace, the markets can do well, the economy can do well, consumers can do well, households can do well. But it's just when, there's this pent-up belief that maybe all of these productivity triggers are in place to keep inflation low, you wake up one day and that's not the case, then the market can react very, very violently to that. So a little bit of inflation on that, but let's see, commodities, we have oil being real strong. We've got a couple of charts on this. We've got large energy producers that are generating better earnings right now on the strength of crude oil that's over $55 a barrel. We've seen a lot of oil production changes here over the landscape in the last 6 to 9 months. There's possibility that you don't have all the OPEC players or OPEC plus players that are interested in playing by these new rules. So, and the fact is, you are likely going to get some U.S. domestic producers, some of the smaller ones that at $55, maybe even $57 a barrel, are willing to uncap their wells and begin drilling again, because it's a little bit more economically feasible. Let's see. We talk about the, just puts and takes. So, and I'm going to draw on some of Sandy's comments. So I've read some of these in the journal, but he does a great job of summarizing these. But we've had charts and charts of the week that have talked about what people would do if they got more stimulus money, and we know basically that a lot of people will be saving it. In fact, from Bloomberg, let's see, more than a third of respondents said that they would save significant amount of money if they received another stimulus check. And that's up versus like 23% in April. And we know that higher income folks tend to save more. And so, in fact, 41% of those making more than $100,000 said that they would save it. So that's, I think, going into some of the thinking on Capitol Hill, that maybe the stimulus checks need to be more targeted to people that actually put it into the market. Let's see. Large U.S. lenders saw loan books decline in 2020 for the first time in more than a decade. And that's just the second time that the loan books have shrunk in 28 years, which is really interesting. So credit is still a little tight. What else? China. What's interesting, the Wall Street Journal has talked about some of the chinks in the armor for China, which actually was the only country to post positive economic growth last year of the major emerging economies. But the arguments there are debt levels have grown at a very fast pace. They've got kind of a bubble in their stock market. Certainly have a bubble in their real estate market, and the consumer spending just hasn't kept up with the overall economic growth. So it'd be interesting. We need to follow China. State and local governments. The irony is that and we know that state and local governments have laid off a lot of people. There's been a total revenue loss estimated about $300 billion through 2020. Costs have gone up in certain cases, and as I've said, a lot of jobs have been shed. But there's been a lot of federal aid and stimulus that has gone out to businesses and households, and that's actually helped to buoy to some degree some of the revenue for some of the states. But let's see. And I think lastly, I just want to focus on the virus, and I don't want to dovetail exactly what we have in the first part of our charts of the week that you can look at. But we've had essentially 45 million vaccinations right now, and we feel like there's probably 10% of the population has received the full treatment protocol. And so that's positive. And, we've had a significant decline in the 7-day moving average of new cases being reported. And we're beginning to see that downtick in daily deaths, and hospitalizations are actually down 38% since January 6th. And even though we're still above, like say the midsummer surge last year, it's a really positive sign, and I think something that it's not unthinkable that we would have more vaccine than arms to put it in come April and May. So, at our pace, and we had 33 million people with a shot in the arm last week, and now we've got 45. So clearly, the pace of inoculations is picking up. So that's really all I have this week that is kind of on my mind. The basic themes here, just to close out, equity market still doing very well. We've had some shifting of the guard, so to speak, in leadership. Earnings have been really strong, and earnings estimates are actually really strong for the time being. That's good for stocks, even though valuations are high. They're not as high in some respects as they were in 1999. But they are high, and so I think there might be a period of volatility with some of the economy settling out, and some of the short-term high-frequency data is kind of choppy a little bit right now, and we're not at herd immunity, so there are still restrictions, there are still limitations and governors that have been placed on our economy, and we still have a labor issue where we've seen a lot of, we still have, 9 to 10 million more people out of work. And we're also going to be dealing with a massive budget and fiscal deficit. We know that just, for January alone, it was 165 billion. And that, by comparison, in January a year ago, it was only 33 billion. And then, the Congressional Budget Office is projecting, almost 2.3 trillion in deficit for 2021, which is an astounding number, and it just means that we're going to be issuing a lot of debt, and a lot of that debt will have to be purchased by the Federal Reserve. So that leads us kind of all points kind of lead back to this risk of inflation that we're going to have to get our arms around and hopefully control. So anyway, I'm still very optimistic. Long term, I still think we're in a synchronized recovery of sorts. There's a lot of opportunity for growth and recovery, and the main thing that we're going to have to do is watch out for policy mistakes. I think we've got a good Federal Reserve, a Fed that has its head on straight, that is going to make good decisions and not be too preemptive and take the wind out of the sails of the market and the economy before it's time. So that's about all we got this week. Appreciate you spending time with us. We'd love to hear from you. If you have any questions, you can reach us at the information that you see here. Be warm, be safe, and have a good week, and we'll talk to you soon.